Folks, great to be on with you. Great to be on with Chris Irons, um, also known as Quoth the Raven. Pete always calls you
It's
Quoth.
quoth.
I
Quoth.
know. That's what I
All
told him. I
right.
said, Pete, you're taking it too literally. It's Quoth the Raven, nevermore.
Yeah,
It's not
Pete
Quoth.
said. I think Pete said quaff to me in person once. So like, what the fuck am I gonna do? I'm not gonna say anything. You know what I mean? I'm like, yeah, that's it, Pete. Sounds good. This
Yeah,
is
that
like
must
six.
be it, Pete.
Yeah, exactly. But I've been saying it wrong this whole time. You know.
So, Chris, I think virtually everybody watching knows who Chris is, but he is not just a short seller, but he happens to be an excellent short seller. And he writes newsletters and periodicals for very big institutional traders. Correct, Chris?
I do research for short sellers. Yes, I do research for some well-known short sellers, and I also host a podcast called the Quote the Raven Podcast, and I am active on Twitter. And every once in a while, I write something of my own and publish it on my website as well.
Fantastic. Well, you have nailed this move in the market. And so, number one, I wanted to give you credit for that because I know other people, some people like to copy your work when they see you post something smart on Twitter, which is frequently, or when it's something funny, which is also frequent. And I like to retweet those as well. But I retweet you. I don't just try to claim it as my own. Um, I know some people, though, are not nearly as giving. And so they more or less take some of the stuff that Chris says and like to make it their own. But I've been both fascinated and impressed, Chris. And obviously, you wouldn't have people buying information from you on the institutional side unless you were good at what you do. And so my hat's off to you. I think
Thanks.
it's been a hell of a call.
Yeah, thanks. And just to address something that you said there, I thought I was the only person that noticed every once in a while I would tweet something else, and then it's interesting to see something very, very, very similar appear on somebody else's Twitter account or perhaps even on television. And you're like, oh, interesting. Especially when, that's a different story. But thank you for that. And it sucks that this turns out the way that it did. I mean, I just had a call the other day with somebody else saying the same thing. Like, you called it, and I just said, I would give up my P&L. I would give up my PA right now in a second to have a solution to what's going on. It's a drag that what I was saying in January came to fruition. Although, at the time I thought it was an inevitability, just using common sense, just from what I know about China, from what I was reading about, what PhDs and experts were saying about the coronavirus back when it was just first starting to be reported in China. And then, as the weeks carried on and we got more information outside of China, it became abundantly clear that this thing was not going to stop. And there's a couple of reasons that I think people have misjudged this wholly. One of which is, the central banks have created an environment where people believe money can be thrown at every problem and fix it. And that's precisely not the case here. This is a biological problem. It's not a financial problem. And I knew it was going to be a rude awakening. And it sucks that I had to be right about this because, it's going to be sad what happens. And it's already sad that this has reached the stage of, a global pandemic.
Oh, yeah. And I know just what you mean. It's also kind of sad, Chris, that when I look at this and I look at all these people, Buffett always says something like, who's swimming naked when the tide goes out,
Right.
Something like that. You also know some of the world leaders when they're not really leading, when like 2 weeks ago, Christine Lagarde gets on and says, we got to do something. And yet for 2 weeks, we've got nothing out of, the ECB. This is the former head of the IMF. And she should understand as well as any of us, certainly as well as Chris Irons, that there's an issue here that's going to need to be addressed. Because if indeed we quarantine, which seems likely, Chris, one of the only things we can do at this point is to, other than to stop people from panicking, we need to basically keep people away from people for a while so it doesn't pass. And then if you have a temperature, stay home for 14 days. Don't be out there mixing it up in public and all that kind of stuff. But there has been nothing from most of the world leaders as far as how to address this, except for, a regime in China that can tell people to do whatever they want or, face the consequences, which might be death.
Yeah, if there's one benefit as to what China did in their response, it's that they can take these draconian kind of measures and, their citizens will adhere to them and do it. I mean, otherwise, it will be severe consequences for them. I mean, they don't quite have the same set of civil liberties that we do here in the United States. The problem here in the United States is, I mean, to me, it feels like this is inevitably going to reach a similar scale as it did in China in the United States. I think we're fooling ourselves to think that, the World Health Organization came out again today and said, this is the first pandemic we can contain. And I just don't think that's the truth. And anybody that's been reading what I've been writing and reading, or listening to what I've said in my podcasts over the last couple of months, is that this thing is way out ahead of us. Our response to this in the United States, I mean, China did about as vigorous of a response as you could do. So much so that it left me very skeptical about their data. Their response to me didn't seem congruent with the data that they were reporting. But this is out ahead of us right now, okay? So we are, right now, what we're doing and what we're reacting to is stuff that's happened 6 weeks ago. We're just now starting to get tests out. The reason the numbers are going up is because the testing is becoming more ubiquitous. Well, that doesn't mean that there's not people walking around with this right now. That doesn't mean that there's not people that had it in December and January in the United States that may have already had their symptoms come and go or may have been misdiagnosed as having the flu. We're way behind this. And so one of the things that I've been urging, specifically, I did a podcast on February 8th when the market was still hitting all-time highs on the news of, this pandemic being out there and people were betting, because there's going to be a stimulus response, we can go out and bid up stocks. One of the things that I talked about then was that the lag between the reality of what's going on with the virus right now, or what maybe this week, right before all these events got canceled. Buddy just sent me a video of spring break. People are still very congregated closely in places like, Miami and major cities. All these things that occurred over the last week. I mean, the virus is doing what the virus does. It doesn't know what day it is. It doesn't know what time it is. It doesn't know whether or not we're injecting liquidity into the repo market. It doesn't know what the stock market did yesterday. It doesn't know what Donald Trump did. The virus is out there and it's going to do what it's going to do. So it's unfortunate that, 2 months ago when I started to talk about this stuff and urge people that maybe, hey, you should take preparations before this, becomes too late, because I realized that the mainstream media is a hugely lagging indicator on what's going on now. So what you watch on Fox News, on CNBC about the coronavirus now is all shit that's happened a couple of weeks ago. And so, when I go out there and try to urge people to do that in January and say, hey, maybe buy masks, maybe buy this, that, and the other thing, people say, oh, you're a fear monger, you're creating a panic. There's other people, too, that have said, not that I give a shit at all if anybody thinks that I called this or didn't call it, or really, I don't really care at all what anybody thinks about anything. The point of the matter is, though, for people to say, oh, that, nobody called this just because they didn't see anybody call it, or because they didn't think it was possible, or because it came from somebody that has a skeptical and bearish view on the macroeconomic system as a whole, like I do, that doesn't void out the fact that there were people, and it wasn't just me. I mean, even Mohammed El-Arian was saying things weeks ago that I thought made a lot of sense. The gentleman from Peak Prosperity There were a couple people that came out and were really urging caution months ago about this. And I think it's a shame that, you know, I think it's a shame that, you know, we had to be right about this. I would much rather be wrong and have this thing taken care of. But reality is reality, and reality, you can embrace reality or you can play it off as though nothing's wrong. And thanks to, I think, the last 11 years, really the last 20 years, since the 18 months for the global financial crisis, the Fed has made us feel very comfortable and has given us the idea that there's not a problem out there that we can't solve by printing money. And lo and behold, fucking bingo, one of them shows up right now. And all the while over the last 10 years, while people were saying that, the Fed should have been tightening while it was easing, while the economy was quote unquote recovering, we got lambasted. We got lambasted for saying that. We were ridiculed, made fun of, whatever. But now here we are at a spot where we're really going to need some serious stimulus or something if we plan on trying to prop up the capital markets. And all of a sudden, the interest rate lever is as low down as it'll go. So it's a shame that this has happened. Your friend Guy Adami gave a beautiful speech about this on CNBC yesterday that I tweeted out yesterday. And I encourage everybody to go on YouTube and look up Guy Adami's speech about this yesterday. But it's a shame. It's honestly, it's very sad. And it sucks that we that we were so hard-headed and thick about this. And, now everybody's getting it. Now that it's on, now that Sean Hannity's talking about it, everybody's starting to get it though, John, like too late, right? And so the people that prepared, people that chose not to prepare are scrambling a little bit. And so.
Well, let me ask you this then, Chris, because I know when things not on the same scale, because, this is a huge call by you. So I'm not diminishing it and saying, oh, I have lots of calls like this. I'm not saying,
Sure.
But when you have a huge call like this, and all of a sudden, all of the folks in the mainstream media, some of which you named, a lot of which, of course, we're not going to name, or at least I can't name, because of various contractual arrangements that I have. But a lot of folks are jumping on your bandwagon right now. Now, does that make you nervous? Does that make you think we're getting closer to a flip point? Or are you just saying, well, it's just like when Tom Brady's beating a team by 30 points every Sunday, that finally enough people go, okay, I'm with Brady now. Finally, I think they're going to win, they're going to cover, and they're going to win another Super Bowl.
Look, I'll be frank with you. The only person that I've seen keep it real on television was that speech that Guy Adami gave yesterday. And I've talked to Guy Adami long before this took place. He's been on my podcast. I've had several conversations with him, and I know that this is how he felt beforehand. And, the other guys that are making appearances, your Peter Schiffs, guys like that, I mean, we know that that's how they've felt for a long time and how they're going to continue to feel. It's not about always being bearish. This is where I think people get mixed up. And I could care less about getting credit. You say, oh, well, people jump on your call, whatever. Yeah, I'm on my Twitter. I make snarky comments because I was saying this shit 2 months ago and I was getting a lot of shit for it. You can go back and read my tweets. So yeah, I'm making a couple of snarky comments. But I'm not, this isn't some like ego thing where I'm like, oh, great, like I'm the guy that called it. So anybody that wants to agree with what I'm saying, and and more broadly, anybody that wants to be a skeptic of monetary policy as a whole, I embrace that. Like, I welcome that. The only reason I started a podcast and the only reason I'm so active on Twitter is because I can't find any of this shit anywhere else. Nobody else in the mainstream media is saying it. So what happened was I learned about finance. I learned about central banking and fractional reserve banking. It became clear to me that a lot of it was bullshit. I looked into it a little bit further. I thought what we were doing over the last 10 years was absolutely ridiculous. I wanted to hear more about it. None of those people were invited on television anymore. So I said, all right, I'm going to start my own podcast and I'm going to talk about it. But there's plenty of room on this boat. the common sense train here. You're more than welcome to hop on and join. And I don't care. I don't care if I never do another interview, if I shut down my Twitter tomorrow and disappear into the abyss. This isn't some like, oh, I'm always a bear thing. It's just, a lot of people think I take the position of being bearish and then draw my conclusions from that. And that's my thing. I always have to revert to this, oh, I'm always bearish, That's just not the case. I bought a couple of stocks today. I bought, I nibble here and there, whatever. I have a long only portfolio. I have a short book. I own physical gold. I consider myself diversified. I don't say, oh, what would the bear do in this situation and do it? I'm a bear because of the conclusions I've drawn about the way that we run monetary policy, not only in the country, but globally. So that's how I get to the mindset and adopt the ideology I'm in. I feel like the whole system really is fucked. And I act based on that. It's not a character that I'm playing or like I want to be Mr. Dr. Doom or whatever, one of these guys. I'm just trying to plug my brain in and use my common sense. And that's it, I said to my buddy last night, I was talking to him on the phone. He's a very good friend of mine who I care about very dearly, who lives in New York City. Okay. And about 8 weeks ago, I started spamming him with text messages saying, you're going to want to get the fuck out of New York City. I'm telling you, eventually you're going to want to get out of New York City, start making preparations, Meanwhile, I had already been making preparations for a while. So I said, buy a couple of things, buy some food, buy this, buy that. And he, at first he's like, yeah, all right, whatever. But then a couple more times I start spamming him with messages and annoying him about it. And he starts, picking up and threading the needle a little bit. And he's like, okay, yeah, maybe I'll get this, I'll get that, starts picking up things here and there. And this is back in like early February, right? Because I'm thinking to myself then, like, this shit is out there. We just don't know about it yet. The bottleneck is the testing. It's still the bottleneck, So just 2 weeks ago, he rented a place outside of the city, out in the country somewhere, a couple 100 miles away, and said, you know what, I'm going to just take the family up there for a couple months, let this thing blow over the city, just in case. What happened? He was there for 1 week. He got an email from his building supervisor that said, hey, we just had a report of coronavirus in the building. We're shutting down the building. We're locking it down. We're doing, guys in hazmat suits will be around, whatever. So why am I making that point? Because it reminds me that I'm not completely insane. When sometimes I feel like either the problem is I'm embracing reality more than I should be, and I'm letting the gate swing too much in the other direction. I'm being too paranoid or whatever. But when something like that happens, it reminds me that like reality still happens. Reality takes place, regardless of whether or not you, me, or some 24-year-old with a Robinhood account and acne is comfortable with it.
Well, now, since you went there with Robinhood, did they open up today? Were people able to trade in their Robinhood accounts?
I think so. I didn't see any warnings like I did the last couple of days.
All right. Well, good for all of you guys and gals that did that. But that's a dangerous thing. If you need to get trades on, most of us would say, A, that you need 2 accounts, but certainly you need one of them not to be Robinhood.
Well, and it's a very good reminder and it probably was a very hard lesson for some people that lost money because of the outage of what diversification really means. People laugh at me because I say, oh, like diversification isn't just, hey, like I have one account with Fidelity and I'm half in stocks and half in bonds. I'm diversified, diversified I don't think we have systemic financial risk right now, but in a case like that, diversified means that you have assets across several institutions. It means that you have assets that the banks can't get into. It means that you have, it means that you hold assets other than dollar-denominated assets, other than equities, other than just equities and bonds. And, assets are like real estate, which you can have assets like gold and precious metals. The broader you can diversify yourself across platforms, across banks, across industries, across global geographies, the better. Diversification is not putting money in one account and putting half in stocks and half in bonds.
Right. Let me ask you about one that you might not trade that much, but I've been trading it lately, and that's the HYG. Now, this
Okay.
is a high yield corporate bond ETF. I know you know that, Chris, but it has made some wild moves lately. If you look at a multi-year chart of this thing, like for instance, high yield bonds, when they have, you know, disruption, like approximately on the charts I'm looking at, you know, the basically, Chris, the low that we put in was about Christmas Eve 2018. And we all know, you know, that's when everybody was throwing the baby out with the bathwater.
Yeah.
They were upset. They didn't think the Fed had their back anymore. They thought that Powell and the group was just going to keep raising interest rates because they'd just done it again. And they're saying there's no way they're going to keep, they're going to do this again. And they did it. And then the high yield bond market just dumped. And as it dumped all the way down to, I'm showing a low of roughly 79.50, let's call it.
Yeah, I see that too.
Then obviously we worked our way back up. You know, they're cutting rates, make the multiple rate cuts. And then when I shorten that duration down to about a month, we see how quickly from the beginning of March, this goes from, you know, an $86 number to now under 81. And a very violent move in the last 2 days, Chris, because obviously Monday we slid hard on that 2,000 point Dow drop. Tuesday, we had that knee jerk back. You know, we were up 1,200 in the morning. We gave it all back, went negative, and then we ran all the way up again when we heard we might get some sort of tax holiday, some sort of, you know, something other than just the giveaways that the Fed was doing. We were looking at what would be the other giveaways that the Congress and the president could give us. And we rebounded on Tuesday in the high yield bond from about 81.30 to about, call it 82.64 we closed yesterday. So that was more or less a $1.30, let's call it a $1.25, $1.30 rally, which is fairly big rally.
And down here at 80, what are you getting paid to hold this flaming pile of dog shit packaged into an ETF? What's the coupon here that you're getting for holding a, you know, without reading the prospectus, probably what is a collection of the world's worst corporate debt? What does it pay?
Well, let's see. It pays 5%.
All right, so that's an atrocious yield for any kind of junk debt, as you know. It's definitely an atrocious yield in the situation we're in right now. And high yield corporate bonds are something that I wouldn't touch. I wouldn't touch this ETF if it went to 10. I mean, we have no clue what's going to happen here. All we know is the leveraged loan market is a disaster, that there's arguably the most corporate debt outstanding right now as a result. And yes, rates have come down again, so that'll make it a little bit easier to service the debt. It'll make it a little bit easier for companies to refinance yet again, as they've been doing over the last 10 years. But 5% to hold a collection of crap, and it probably might not all be crap. I'd have to look at the prospectus, but I guess a majority of it is crap. At a point now where we have, you know, several black swans all appearing at once, one being the oil market. So, you know, I don't know if they have any exposure to shale, but the Permian Basin is full of companies that basically spent the last decade falling on top of each other and getting too close to wells. And, you know, when they couldn't provide what their investors were pitched, they went and restructured and took on debt. So all those companies are levered. A lot of them are going to blow up now as a result of this move in oil. And honestly, you know, a lot of the regular equity market, other industries, isn't much different. There's a lot of garbage companies with terrible balance sheets that aren't generating consistent cash flow. And you have to be willing to get paid 5% here to bet that the slight tick down in interest rates now is going to offset what looks like is going to be an enormous shock to the entire global economy, the likes of which we're not even close to feeling yet. I mean, we're getting a little bit. This is the market kind of, predicting that in a couple months things are going to get bad, but we don't really know how big of a shock this is going to be. And also, when people hear this stuff about, oh, China's going back to work and the factories are back up in Wuhan and they got it under control, I mean, that could be total bullshit. We don't know that. I spent a half decade looking into U.S. listed China-based companies and dealing with Chinese nationals, and I wouldn't be surprised if they're lying 100% to our face about everything involving this virus. I think, I hope that they're not, but that was part of the reason I was such a skeptic to begin with. So things could be far worse in China right now than we think it is. And what would happen if the situation in China is still a disaster and we still have to wait for South Korea, Italy, Europe, and the United States to have those Wuhan moments? I mean, I went to Best Buy, a week ago as I was preparing stuff for my lockdown that I'm doing, right? And the kid at Best Buy told me the store had been dead. And he's like, I don't know. I think maybe it's that virus thing. I'm not sure. That was a week ago. Take that and extrapolate it across every retail name, every travel agency, every cruise line, every airline. Now with oil getting rocked, the oil and gas industry is screwed too. And there's not going to be enough, money to bail everybody out. And if they do bail everybody out, it's going to be a huge money printing shit show, which is another story. So, I mean, we have to think really long and hard. This isn't the time to go chasing high yield debt, especially high yield debt that pays 5%. If you told me this thing paid a 14% coupon, I'd be like, all right, maybe I would read the prospectus. 5%, I think you're crazy.
Well, this will make you think that your read on that is correct. In January, when this index was about 88, the HYG, it traded about 265,000 puts per day, and that's about 5-to-1 puts to calls. Now,
Sure.
That's typical because most of these, you see a lot more puts trade than calls. People, protecting if they can, or trying to at least, their ownership of exactly what Chris just described, folks. So they might say, well, I got a 5% yield, doesn't really feel like enough, but I think this thing could go to 100 or whatever.
Right. And plus this trade's kind of like a bond, I'm assuming, where, it's not going to go up too high in the sense that, if you're buying more puts than calls, your downside if you're short this thing is limited kind of to some degree because it does trade like a bond to some degree, right?
Yep. Well, then last week, during the, as crap hit the fan, both bullish and bearish crap, because we were up one day, flat the next, down hard the next, and so forth. It was averaging about 500,000 puts per day and 9-to-1 on the puts versus calls. So again, very elevated. Today, Chris, and by the way, yesterday it fell back to, the same about 500,000, I think, puts per day, but it was about a 4.5-to-1 puts to calls. So in other words, it was almost back to the January levels as we rebounded 1,100 or 1,200 points yesterday. Then, today, it drops about $1.80 from 82.64 to 80.84 on the close. So call it $1.80, and it trades 1 million puts today. People absolutely panicked, and that's a 15-to-1 puts to calls ratio in here. So you've got fairly steady the same number of calls per day, and all of a sudden this thing goes up and trades 1 million puts in one session. That's today. They're basically panicked that we go to and through that December of 2018 level. At least that's what a lot of the big block buys were looking like. And keep in mind, folks, like when Chris when he was bearish on things in 2018, which I imagine he was in some things, assets, the interest rates were significantly higher. This is with the interest rates down, back down to where they were before the Fed hikes, and with the likelihood that a lot more stimulus is going to be coming at them, and they're scared.
Yeah, let me just say that, just to speak to your point about being bearish then, and just being bearish in general, I think it's really important to differentiate again that, I'm a skeptic. My beliefs, a lot of them derive from my skepticism of, Keynesian theory and monetary policy, the way that we're applying it now. I don't think it's going to work over the course of the long term. I think that's something we'll have to give. I'll either be proven right or I'll be proven wrong. But I'm not, it's almost a misnomer to just say that I'm bearish all the time. I mean, really what I am is I'm a skeptic all the time. But I also realize, I think unlike some other people that are perma bears, if you want to call them that, this system is going to play out the way that it's going to play out also too. And I saw that this was something that another person that wrote something about this took exception with. Oh, it's perma bears that also say they think you should ride the way up too. And to some degree, the beef that I've had, and in 2018, what did I say? I said, well, I don't trust the system, so that's why I own more of a percentage of gold as a total weighting of my portfolio than most people. And that's what I said. I didn't say go out and buy SPY puts. I didn't say, that the market is going to crash tomorrow. I very rarely give timing on calls, although I just say, overall, I'm a skeptic, and I just try to let that guide me. Doesn't mean I don't go long stocks. Doesn't mean that I don't day trade. It doesn't mean that I don't, buy fiat currencies and trade the Forex markets. But all in the back of my mind, I have a voice that I think is louder than the average person that is reminding me that what I think this unprecedented experiment that the Fed is on can't last forever. And I think that, you can apply that to a bunch of strategies. And are you tweeting right now? Are you tweeting right now while we're doing this interview? I just saw you post a tweet.
I did. I was just thanking Bill Pulte for saying you're a good man.
Well, you're not even listening. You should have Bill Pulte on the show then.
I'm listening.
I'm just breaking your balls. Don't worry. I got things playing on this monitor here that we can't even show people. So don't worry about it. Thank God.
Yeah, thank God you got
No, so I think there's a very big difference between just being like a perma bear and just being skeptical of the system. And when I gave a speech in summer of last year that was in response to an article that Josh Brown wrote called "Perma Bears Are Ridiculous People," I took that in definition to mean anybody that's skeptical of the buy and hold, the long only thing, is a ridiculous person. But I don't really see myself as a perma bear. I just see myself as a skeptic, trying to make my way through the market with what I think is a broader view of things than most financial advisors that you're going to find at, most junior brokers you're going to find at an AXA Equitable Advisors, whose phones are lighting up over the last, 3 weeks, causing them to have developed drinking problems while they assure their clients to buy more SPY ETFs and hold for the long term.
Oh, you know what? They're also telling them to buy Vanguard.
Yeah.
Whether you're buying any of these S&P like products, folks, I guess Vanguard makes sense only because it's such a low commission, Chris. But nonetheless, there's way too many folks that are just piled into these, and you can just see when they're unwinding these things, the carnage that they create, just like they did today at noon, when all of a sudden, Chris, at about, just after noon, when the WHO said, by the way, we admit now it is a pandemic. When they admitted that, and we had been clawing our way back to being down about 790 points, and then at about 12:15 they came out with that 12:15 Eastern time, and next thing you know, we're dumping 1,000, 1,100, 1,200, right, and so forth, because I guess some people might trade off of headlines like that. I don't. But I follow, as I've always said, the smart money. And for the most part, the smart money, as Pete has been very patient, has been waiting. And eventually, the smart money will come back in waves. They probably won't go, uh, they probably won't go 40 or 50% in a single session. I doubt that, but I think they will start wading back in the next little bit here. That doesn't mean it'll be enough to stem the bleeding to the downside, because a lot of folks were asking me, Chris, well, for instance, uh, if we start going down, at what level, do you think I should start buying back in? And I said, why? And they'd say, well, because we'll probably bounce at 10%, right? And I said, we might, but if we don't, be careful, because what's going to stop it? And they're like,
Right.
well, the Fed, or, the buying out of mutual funds and retirement funds and all that. And I said, that came in January. I don't know what you think is going to be coming in here. If you're not saved by, a whole bunch of risk takers coming back into the market, you can forget about, the 401k funding, because right now, Chris, going into April, even though it's probably the move to make, how many people do you think would actually, if they didn't fund their IRA, Roth or otherwise, 401k or otherwise, if they didn't do it in early January, which, a lot of people do, hoping to catch a wave into, the first quarter, if they didn't do it then, are they likely to do it into April 15th, which still might get extended out further, I've heard. But would they be likely to do it now? And I'd say no. I'd say they won't, because they're going to be scared.
Yeah, we haven't even seen capitulation yet, right? So when you talk about people blowing out of their ETFs, I mean, I think what's been going on here over the last 3-4 weeks is you have the common folks still thinking that this is an opportunity. And I know it just from talking to people outside of the world of finance that I know. So when I go to the gym, the people that I train with, and when I, go to the bar and I talk to people that I see out at my local pub, which are, mostly just working class people, the vibe that I get from everybody is this is an opportunity. My buddy told me the other day, I took this opportunity to rebalance my IRA and add to my IRA. I was like, okay, and I don't really give financial advice or comment on those things to people that aren't, that don't want to talk a lot of finance. And also just because I don't really like to tell people what to do, but I don't think that we've seen capitulation yet. I really don't. I think those people will all think everybody's operating now that they're under the assumption that this will definitely just go back up and it'll only be a certain amount of time. And while that may be true, I think these people are thinking like it'll be 4 weeks, when we don't really know what the long-term impact of this recession and, more importantly, the Fed's response to it is going to be. We don't know if it's going to take 4 weeks, 4 months, 4 years, or 4 decades. I mean, we could turn into Japan as a result of what we're about to do from fiscal and monetary stimulus as a response to this, right? And let me just go back to ETFs real quick, right? We're talking about Vanguard, and yes, I think you're right. They do have the lowest fees, which is what makes them popular. Inherently, I don't have anything against ETFs, right? I make a lot of jokes about it on Twitter because that's what financial advisors get paid for, to tell you to put your shit into ETFs and leave it there, okay, which anybody can do. So if you're a financial advisor and you got some guy telling you, this is what we planned for, I got to do my job now and keep you in the market. Every bear market has always resulted in the Dow going higher, over the course of time. Buy when there's blood in the streets. If you're one of those people, that's what I take issue with, because that whole ideological framework exists under the umbrella of the central bank can't eventually just break the market for good. And they can. We've seen it in Japan. It's possible for central banks to do it. It's possible for there to be hyperinflation in the US. It's possible for all these other black swan events that people write off and don't even consider when they talk about just buy and hold, just buy and hold and wait, and everything will be fine, no matter how low the market goes. Well, you don't know that. You don't know that the Fed's not going to do something that, if you've been buying over the last month, and we're at a 20% drawdown from highs right now, that the Fed's not going to collapse the market another 40%, and that it's not going to stay there for another 5 decades for the rest of your life. You don't know. Nobody knows, because what we're doing is an unprecedented experiment in monetary policy. So my beef isn't with ETFs, and it's certainly not with Vanguard themselves. I own Vanguard ETFs in a certain portfolio of mine. I have a long-only portfolio that just sits and just spits out dividends, just in case the whole system doesn't collapse during my lifetime, which is the same reason I don't try to make predictions on a time period. Although I do think the system is inherently flawed, and it will happen at some point. So I have that type of book, and I have other types of books to prevent against a systemic breakdown and a real shock. The point of the matter is there's nothing inherently wrong with that. What I take beef with is fucking people saying just buy and hold, and every bear market has always wound up in another bull market, and we always wind up going back to all-time highs. And by the way, my work here is done. I'll take my fee. That's total bullshit. And Josh Brown wrote something yesterday where he said, in the same article where he said, well, nobody called this. He said it takes no talent to have called this or to be a permanent bear. And somebody posted a great response, which is it also doesn't take any talent to just sit there on cruise control with the long-only mentality and get crushed every single recession. Yes, the market has always recovered historically from recessions, but anybody that will talk about prognosticating in anything, whether it's the stock market or fucking the guy watching the horse races down at the Turf Club in Philadelphia, will tell you past performance is not indicative of what's going to happen in the future. So when I say I would rather hear from somebody like Guy Adami than Warren Buffett, which is what I tweeted to Josh the other day. By the way, I don't have any problems with Josh. He's a nice person. We've had nice conversations together on Twitter. This is not personal. This is just ideological, okay? He said to me the other day, he put up a tweet saying, oh, what a good day to have Warren Buffett on because the market had started to crack. And I was like, really? Like, I would rather hear from the perspective of somebody that doesn't think it's all going to be okay and isn't a perpetual optimist. Not because I'm not an optimist myself, because I don't want to feel fucking fine and dandy all the time, because I do, but because reality doesn't always exist on the optimism end. Sometimes, as we're seeing with this pandemic, reality is just bad. It just sucks. That's the nature of things. That's nature in general. So I would like to hear from a Peter Schiff, or from a Guy Adami, or from a Bill Fleckenstein, or from a Keith McCullough at Hedgeye, or somebody that I know is going to be a little bit more towards the objective center, or a little bit more towards realistic when they're commenting on these things. And he tweeted back to me, oh, you'd rather hear from Guy Adami than Warren Buffett? And my answer is fuck yes, because I know what fucking Warren Buffett's going to say. It's the same shit he said for the last 50, 60 years. There's no doubt the guy's a billionaire. There's no doubt he's, one of the great investing geniuses of our time. But his system of buying and holding and buying into every single dip, yes, his timing has been very good, but it all exists within an ideological framework of the central banks are always going to be there to bail us out when bad shit happens. And I just don't think that's the case. So if you go again and watch my man Guy Adami's video from yesterday on YouTube, you'll see exactly why I would rather hear from fucking Guy Adami than Warren Buffett in a situation like this. And no disrespect to anybody here. I'm just talking about ideology.
I gotcha. Now let me ask you a question. I know we don't have much time, Chris, because your time's precious. I know. And you've got a bartender that's probably missing you right about now.
No, actually, I have a bottle of brandy here. I keep it in my closet just in case shit gets haywire. This bottle of brandy in particular cost me, I think, $9. So I keep this close to here. And then if shit goes bad, you never read those questionnaires when you're in health class in high school where they're like, the signs of an alcoholic, and they're like, hides bottles around the house. Fucking check mark right there.
Chris?
I'm my own bartender. Yes, sir. Sorry.
When somebody turns a trade into an investment,
Yeah.
it's one of my pet peeves, because the reason that happens 99 times out of 100 is they bought it for a trade and it didn't work out. So then they say, okay, now it's an investment. I imagine that you discipline yourself so that when you've got a trade that isn't working, even if you have a strong belief that we're going to go south, or a strong belief that a stock is going to get squeezed and go to the upside, I'm betting that you have a stop loss in mind for a loss you're willing to take, rather than just keep bleeding. What is that for you? What is your level of stop loss?
It all depends on what kind of trade I'm trying to make, right? So if I'm buying something that I think can be a longer term hold, actually, I'll do the unexpected and give Jim Cramer some credit, because he always says, buy something that you would be comfortable buying if it went lower. So if you're looking at the long term, that's exactly the mindset that you want to adopt, right? And I'll give you a perfect example. Before the close today, I bought a very, very, very like 0.2% of capital position in Raytheon. Now, why is that? Raytheon traded, I think, at 154 at the end of the day today, or 155. Why is that? Because Raytheon is a stock that if it went to 70, I'd be okay with buying some more of it. If it went to 30, I would be okay at buying some more of it. I think it's basically a wholly owned subsidiary of the Department of Defense. That gives me a lot of comfort. So as a long-term investment, I think that makes sense. If you're trying to day trade Tesla or something, and you buy them at 615, and it goes to 575, and you add, and it's a leveraged company that's not generating any cash, well, I think that's a terrible idea. What I like to do personally, my method is, before I place a trade, I go into it thinking to myself, either I'm okay with holding this for a long time, or this is going to be a 1 hour trade, or a 2 hour trade, or a 3 hour trade, or a 1 day trade. I try to get that time frame set in advance. And I say, perfect example, I bought Lake, Lake, yesterday, which is specifically, it's a pandemic play. They make protective gear. And their stock had fallen back down to 13.5, I think, which is right about where it was before the pandemic news came out. And you could see it spiked like crazy after the coronavirus thing became mainstream. But it came back down close enough to where it was before the pandemic that I said to myself, all right, I feel like my downside is relatively limited. I'm going to buy this basically as a trade. If it goes down to 10 or 9, I'm okay with that. I'll be out. But what I think will happen is here it'll go 15, 16, maybe even back up to 20 plus as the nature of the pandemic starts to, we start to understand it a little bit more.
It closed out today at 1685, up 242, or about 16.7%.
Yeah, it was a good day for it today. And I think it could still go higher. But I guess here's the moral of the story, man. Stop losses are like ripping off a Band-Aid, John. You know this because you did it in person for a very long time on the floor of the CME or the Merc or wherever you traded at. You were a floor trader. And you do it now, I'm sure, with your PA online. And it's one of those things that you get used to after a while. You can't get emotionally attached to stocks if you're buying. You really just can't in general. It's not a very good idea. So if you buy it at 13 and you say, I don't want to take any more than, a loss of $2. When it hits 11, you sell it. That's it. You got it. It's like everything else in life. Just like I want to go downstairs right now and stuff my fat fucking face with a thing of Oreo cookies, and I got them in the kitchen too. I'm trying not to because I have discipline and because I've been eating way too much over the last 3 weeks. I'm going to look like fucking Chris Christie by the time this pandemic's over. I'm not exercising. I'm eating too much. You got to have some discipline. It's the same deal. You see that 11, you hit it. And then one of my favorite things to do, John, I take it off the screen too. Because what happens is if I get stopped out at 11 and the fucking thing goes to 15 after that, then in the past, I would be like, oh, I'm so stupid. I'm this, I'm that. I just take it off the screen, just like ripping off a Band-Aid. The more you do it, the more you have discipline and adhere to your stop losses over and over and over, the easier it gets.
True. I agree with that. Well, Chris, this has been great. You've been very generous with your time. I literally reached out to him, folks, today to say, hey, Chris, A, I wanted to congratulate you on a great call. B, I think you'd have some insights that you've shared generously with the folks on this podcast. So I really appreciate it, sir. We'll make sure we do it again. And, I'm looking forward to seeing you in person soon.
I'm really happy that you and Pete are doing this, Market Rebellion thing. And, just when I look at the people that you had at the conference in October that I was at, you guys are doing a really good job of starting to kind of broaden people's perspectives and get different viewpoints on things. And I think it's extraordinarily important. So I think it's awesome that you're doing that. And can't wait to see you in person too, man.
All right. Well, thank you very much, Chris. Folks, you've been listening to Quoth the Raven. I like to say quote the Raven. Quoth the Raven is how Pete.
Oh, there it is. Yeah, there's the conference.
There's the conference. Vegas 2020. So just go to marketrebellion.com/Vegas 2020 and you can see about what went on at the conference last year and what's going to be going on this year. And I'm sure we'll be talking to Chris more about the markets as well as education of new traders that need a little pep talk and or learn some new tricks. So thank you, Chris.
Yeah, my pleasure, John. Thanks so much.
Have a great one, sir.
All right, bye-bye.